For some, retirement is a matter of 40 to 45 years. For some, retirement is only 30 to 20 years away. In any case, I'm sure many of us will live to see retirement, and it wouldn't be a bad idea to prepare financially for it. In today's video, with tips and advice from the world's richest investor Warren Buffett, I'll focus on building a portfolio for retirement. We'll cover when to start investing, what to invest in, how to withstand market fluctuations, keep an eye on investment fees, why is meaning important in life. Time flies very fast and spares no one. It's the same with the retirement. You should take it into account, plan for it and invest it regularly. Taking retirement lightly can mean lack of money, hardship and completely different worries than having $1 million in an account. What direction to take? In today's internet age, it's not easy to find the direction a beginning investor should take. Taking lessons from investors who have proven they know how to work with money may be one of the optimal paths. When to start investing?
I've actually been a personal net buyer of stocks ever since I was 11, every year. There's been 15 American presidents in my lifetime, more than a third. I've lived under a third of the life. I didn't buy stocks under Hoover. I was only about 6 months old then. But there have been 7 Republicans after that and 7 Democrats. I bought stocks under every one of them.
Warren Buffett is a perfect example of an investor who has been involved in capital appreciation all his life. Warren bought his first stock at the age of 11 in 1942. It was 3 shares of Cities Service Preferred, which he bought at a price of $38 each. This venture was the beginning of his career as an investor. Why start investing early? There are several reasons. The investment can accumulate over a long period of time and the snowball effect of compound interest is huge. The sooner you start investing regularly, the less you need to put in because the interest helps. You can take advantage of dollar cost averaging, where you buy more shares for the same amount when markets fall and less when markets rise. Financial market declines are more bearable in the long run. Let's use the calculator to show 2 examples of investments where only the duration will be different. I invest $10,000 in one lump sum at 10% interest for 10 years, compounding interest monthly. We arrive at an amount of $27,070. However, let's add another 10 years and we suddenly have an amount of $73,280 under the same parameters after 20 years. Therefore, the length of investment is crucial to the accumulation of wealth and in my brief comparison means almost tripling. What to invest in? Many people don't have the time to study the markets, the movements of individual stocks and fundamentally analyze each individual stock they want to invest in. This fact is well understood by Warren Buffett, who recommends that most people invest by the 10-90 rule. That is, invest 10% of free money in short-term government bonds and the other 90% in the S&P 500 low-cost index fund consistently and repeatedly until retirement.
Buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time. So you know the investment universe is going to do very well.
Only true experts and people with a passion for the cause can invest in individual stocks. That doesn't mean they aren't being hurt by fees or bad investment decisions. You will probably agree that if you invest in the 500 largest US companies for 30 years, your investment is much more likely to appreciate than your well-chosen 5 stocks, of which 3 will fail, 2 won't grow much, and 1 will appreciate by a few 100%. I might get a similar appreciation to investing in the S&P 500.
If I had a choice today for a 10-year purchase of a 10-year bond at whatever it is, or 10 years, or buying the S&P 500 and holding it for 10 years, I'd buy the S&P in a second.
But it's up to each individual investor whether or not they want to try to beat the market. As Buffett says, it is hard to beat the market over the long term, even though he is the one who has done it over the long term. How to withstand market fluctuations? It's easy to say invest and hold, but what if your investment drops by tens of %? What if you invest and even after 10 years you still make nothing? Yes, these things happen. Let's look at the Visual Capitalist study. The figure shows how big the historical declines in the stock markets have been. Drops of minus 20% are common, but in many cases they are larger. For example, the minus 52% drop in 2008 was due to the mortgage crisis. What does historical growth look like? Of course, we have to look at the flip side as well. Growth in stock markets is more frequent, larger and longer than declines. We see growth between tens and hundreds of percent. For example, the 582% growth was caused by the internet bubble in 2001 and is the longest growth in stock market history. The length of stock market downturns. You can see in the figure from the New York Times that downturns or recessions last an average of 528 days. The longest downturn lasted in the 1930s in the Great Depression at minus 783 days. Or in 2001 in the so-called dot-com bubble, when the markets fell through an incredible 929 days or 2.5 years. Keep an eye on investment fees. Warren Buffett stresses the importance of minimizing the fees associated with investing because even relatively small fees can add up over time and eat away a large portion of investment. Fees can include commissions for buying and selling stocks, fund management fees, advisory fees, and more. Buffett believes it is important to find a broker or investment platform with low fees to maximize long-term investment returns. He achieves this goal with a simple piece of advice: invest in the S&P 500 index.
And that the trick is to essentially buy all the big companies through the S&P 500 and to do it consistently and to do it in a very, very low-cost way, because costs really matter in investments. If returns are going to be 7 or 8% and you are paying 1% for fees, that makes an enormous difference in how much money you have on retirement.
Fees are essential. To give you some idea of how essential fees are when investing, let's take a look at SchwabMoneyWise.com. Here we find a calculator on which I simulate an initial investment of $100,000 for 40 years with no regular contributions and set the annual appreciation at 10%. I simulate an investment with 0 fees, then an investment that has a 1% annual fee, and an investment that has a 2% annual fee. After 40 years, we will have $2,172,000 in an account with a 2% annual fee, in an account with a 1% fee, $3,140,000, and finally for the investment on which we would have paid no fees, we would have earned $4,525,000 over 40 years. Wow! The difference between an investment with a 2% annual fee and no fees is $2,353,000. Would you want to lose that amount just because of 2% annual fee? I certainly wouldn't. Why is meaning important in life?
You know, there's no important difference in our dress. There's no important difference at all in the car we drive. There's no difference in the television set that we sit there and, watch the Super Bowl on or anything of the sort. There's really no difference in, they've got air conditioning in summer and I got air conditioning. They got heat in winter, and almost everything. So any importance in daily life, we equate on. The one thing I do is I travel a lot better than they do. Net jets. So the travel I do a lot easier than they do. Everything else in their lives, it just, I'll switch places anytime. It doesn't make any difference. Then you get down to the things of health and who loves you. I mean, that's.
Warren Buffett often talks about the need to have meaning in what you do. Many studies from the so-called blue zones, where people live to be over 100 years old, show that having meaning in life is one of the driving forces for achieving longevity. That's why I mentioned this point at the end and end the whole video with it. Reaching retirement age should not be the end of an active life. I think it should be a beginning and an opportunity to use accumulated capital and develop hobbies and desires without having to work 9 to 5. I'm so glad you watched the whole video. Have a great time and think about your retirement. I'm sure you will live to see it.